Today I will cover the basics of income taxes in Canada and particularly focus on taxes in Canada on salary. Taxes are one of life's certainties, and they start impacting us from the very first dollar we earn to the point we die. And yet, we're taught nothing about taxes at school. So my guidance to you is please don't live in the dark. By understanding the tax system and taking advantage of tax deductions and credits, you can reduce your tax burden legally and keep more of your hard-earned money. I'm going to be bold and assume you have zero knowledge about taxes and cover the tax basics. So let's start with how income taxes in Canada are calculated. Firstly, in Canada, you pay taxes twice. First, you pay federal taxes, which goes to the federal government. That is the same for all Canadians. Then you pay provincial taxes, which goes to the provincial government. In my case, that's the Ontario government. The provincial tax rates depend on which province you are resident in. Here in Canada, we have what is called a progressive tax system. This means that you get taxed in tax brackets, which are buckets of income, and you pay a particular percentage of tax on any income that falls within that bucket. For 2023, which is the upcoming tax year, our federal tax brackets are as follows. So for example, if you're an employee earning $70,000, you'll fall into the 20.5% bracket. But that doesn't mean that you'll pay a full 20.5% of tax on $70,000. What it actually means is that on the first $53,359 of income, you'll be in the 15% bracket and pay 15% on this amount until you completely fill that bucket. This equates to about $8,000 in tax due to the CRA. You'll then move into the next 20.5% bracket and pay 20.5% on the remaining $16,641, which is $3,411 in tax due to the CRA. So if you have a salary of $70,000, you will pay $11,415 in federal taxes. Now in this case, your marginal tax rate is 20.5%, which is the tax rate of the highest bucket you ever reach. Now once that is done, you repeat an identical exercise for Ontario taxes using Ontario tax brackets, which I will link down below. So your total tax bill is equal to total federal taxes due plus the total provincial taxes due. There is a common misconception that the more money you make, the higher the tax rate you'll pay on your full salary. This isn't exactly correct. So here's an example. Say you earn a higher salary of $130,000 as opposed to $70,000. First, you'll pay 15% of tax on the first $53,359 of income, which equates to about $8,000. Then you'll pay 20.5% of tax on the next $53,358 of income, which equates to about $10,938. And then finally, you'll pay 26% of tax only on $23,283 of income, and not the entire $130,000. I want to stress that you were always better off earning a higher salary, even if you get moved up into a higher tax bracket. Yes, you will be paying a higher rate of tax on this new additional income, but ultimately, the dollars you get in hand will still be more, and that equals more money in your pocket. Now that we've covered how income taxes in Canada is calculated, let's move on to how you can reduce your income taxes in Canada. One of the easiest ways you can reduce your tax bill on your salary is through tax deductions and tax credits. So what are tax deductions? Tax deductions are specific items that you can deduct from your total income that has tax levied on it. Think of these as expenses that you can reduce from your total income that is subject to tax. One of the most popular tax deductions are pension contributions, also known as contributions to your RRSP, or Registered Retirement Savings Plan. An RRSP is a tax-sheltered investment account that enables Canadians to save money for retirement. All of your investment gains in your RRSP are protected from taxes. An RRSP allows you to postpone paying taxes on the money you put into it until you withdraw from it during retirement. During retirement, your income is next to nothing, and you pay far less taxes on this money than you would if you were to be taxed on it now whilst you're working and earning a high income. So what does this mean to you now, and how does it reduce your tax bill? A contribution to your RRSP generates a tax refund or a return of money from the government. If you have an employer pension plan matching contribution, please avail it. For every dollar of income you put into your RRSP, your employer matches this amount. It is basically free money from your employer, so always maximize this option if it is available to you. If you are in a position to contribute to your RRSP and you don't necessarily need that money imminently, then this is a great way to reduce your tax bill. An important point is that with tax deductions, the benefit gained increases the higher your marginal tax rate. That is the highest tax bucket you currently reach. A tax deduction offers tax savings at a rate equal to your marginal tax rate. To explain this point, let's go through an example. If you earn $70,000 in income and you contribute $1,000 into your RRSP, this leads to $69,000 of taxable income. You go through the same tax bucket steps and you end up with a total tax due of $11,210. This results in a total tax savings compared to if you hadn't contributed to your RRSP of $205. Now suppose you earn $130,000 of income and you contribute $1,000 into your RRSP. You again go through the same tax bucket steps and you end up with a total tax due of $24,736. This results in a total tax savings compared to if you hadn't contributed to your RRSP of $260. The important point here is that for the same $1,000 of RRSP contribution, you saved $55 more when you were in the 26% tax bucket than if you were in the 20.5% tax bucket. This equals to a 5.5% additional tax saved for the same $1,000 RRSP contribution by being in the higher tax bucket, which is equal to the difference in the marginal tax rates. So here's an important tax tip. For an RRSP, you can contribute now when you are in a lower tax bracket, but you can choose to defer claiming the deduction to future years where you may expect to be in a higher tax bracket and hence generate a higher tax savings. Some common tax deductions are RRSP contributions, employer pension plan contributions, moving expenses, childcare expenses, disability expenses, and legal fees. Now we come on to tax credits. A tax credit reduces the total amount of tax that you owe to the taxman. Think of this like store credit you get at a Best Buy. A tax credit is an amount that gets taken off from the final bill payment to the taxman. There are two types of tax credit: refundable tax credits and non-refundable tax credits. Refundable tax credits can generate a tax refund, which means you get a nice big check from the government in the mail. A refund is money back from the CRA. The CRA is the Canada Revenue Agency, also known as the taxman. Think of a refundable tax credit as store credit, that if you didn't end up using it, it can be refunded back to you in the form of cash. A non-refundable tax credit can reduce your taxes owed to the CRA to zero, but it cannot generate a refund. Think of this as store credit that cannot be refunded as cash if you decide not to use it. So for example, if you had $2,500 of a non-refundable tax credit and tax owing to the CRA of $2,000, then your amount of taxes owed would be reduced to zero, but you would not be given $500 back in cash from the CRA. Now, if you had a $2,500 of a refundable tax credit and a tax owing to the CRA of $2,000, then your amount of taxes owed would be reduced to zero, and you would get $500 of cash back in the form of a tax refund from the CRA. Some common tax credits are the basic personal amount. This is an amount of income that an individual can earn without paying income tax on it. Think of this as the first little chunk of income that is exempt from taxes. For the 2023 tax year, this basic personal amount is $15,000 for federal taxes and $11,865 for the Ontario taxes. This basic personal amount is clawed back once you hit an income of about $165,000. Some other common tax credits are the tuition tax credit, interest on student loans, medical expenses, charitable donations, and the first-time home buyers tax credit. One revelation to me that you may find interesting to know is that employment income is one of the highest taxed incomes in Canada. According to the research from Fraser Institute, Canada's top income earners currently pay a disproportionate share of taxes relative to the share of income that they earn. The top 20% of income earning families are the only income group that pays proportionally more in income taxes than they earn in income. The imbalance is primarily due to the progressive personal income tax system in Canada, where higher levels of income are taxed at higher marginal tax rates. Once you hit over $230,000 of income, you are in the highest tax bracket of 53.5%. This means that in every decade or 10-year period of work, you are working approximately 5 years to pay the government and 5 years for yourself. So this brings me to business income. Business income is income that is earned from sole proprietorships, partnerships, and corporations in Canada. Business income is taxed more favorably than employment income. With business income, you can deduct a lot of expenses as part of running your business. So for example, some common business expenses are telephone and internet bills, utilities, fuel costs, car insurance, legal fees, and parking. These expenses don't offer any benefit to you if your only income source is your full-time employment income. If you have a side business, you can claim some of these expenses as necessary for your business to operate. And so you are able to save a significant portion of your earnings in taxes every year. Let me know in the comments down below if you want me to take a deeper dive into any other areas of taxes in Canada.